Hi, everyone. Thank you for joining us today. We are super excited to talk about tokenized real estate. My name is Harrison Adams. I'm a financial markets real estate associate at PwC, and I'm also personally very passionate about Web3 and the potential for real estate tokenization. So go ahead and introduce our panelists today. We have Peter Bryce from Everrise, Jonathan Dunsmoor from Dunsmoor Law, Ryan Berkun from Teller, and Sanjay from Roofstock. Super excited to moderate for these esteemed panelists. So if we just want to go down the line here, and if you guys want to introduce yourselves and just give a brief overview of your current role, starting with you.
Sure. Hi, everyone. Thanks for coming out. My name is Peter. I'm an attorney in the city, but I've been lucky enough to do some business and legal consulting for a couple of blockchain companies, including Everrise, which is focused on personal digit wallet security and peer-to-peer NFT transfers. One thing I'm interested to talk about regarding real estate is specifically, I do think that self-custody is a major value add in the digital space, especially the Web3 space. So to the extent we are giving up self-custody in order to kind of appeal to the grandma problem, how do we get disinterested folks involved? I am curious to what extent we give up custody, which in my view is the central value add of non-Bitcoin blockchain technology. So looking forward to the panel.
As am I. I'm attorney Jonathan Dunsmoor of Dunsmoor Law. We try to make sure that none of you people go to jail, or if you're in trouble, we try to get you out of trouble. Most of the things that we deal with involve some type of securities, real estate being one of the things that is the holy grail of tokenization and securitization is the wonderful world of real property. And so it comes across my desk quite often, and then most people don't understand the complexities around it. And once I have a little conversation with them, they normally try to change their tune or get the hell out of the space and move on to something cool. But I am looking forward to this panel. I think we've got a lot to discuss, and I hope to be back here next year with hopefully more solutions and more answers to these complex problems, including self-custody. We'll see if we figure that one out, but God help us.
Self-custody of real estate, that's why we're here. Hi everyone, my name is Ryan. I'm the founder of Teller. We are a money market, a DeFi money market, where any coin can be used as collateral, any ERC20 or 721. And just last year, we teamed up with Roofstock to sell the first financed, on-chain finance real estate property in crypto. That was back in October of last year, and we actually had a second sale also completed earlier this year.
I'm Sanjay. I lead Web3 at Roofstock. Roofstock is a prop tech company specializing in the single-family rental asset space. For those of you who don't know about that asset class, it's 20 to 22 million rental units that represent about $4 trillion in GMV. The Web3 component of it is we're trying to make it faster, cheaper, and more transparent to sell and settle single-family rental properties using Web3 technologies, and then use asset-based financing options as opposed to the more traditional consumer loan underwriting process that you see in the real world. And our partnership with Teller allows us to instantaneously finance loans as though you would be financing against a punk or an ape. It's basically based on the value of the underlying asset. You get a 60-65 LTV loan, and you complete the transaction in minutes as opposed to several weeks that it takes in the real world. Glad to be here.
Awesome. Thank you, everyone. So Sanjay, I want to start with you talking about real estate NFTs, and then maybe later in the discussion we can talk about security tokens as well. But I want to hear from you the process for how you've helped lead the charge for selling homes as real estate NFTs, and what that process looks like, and some of the homes that you've recently sold.
Mm-hmm. Yeah, no, it's a great question. So when we started off, we had two paths we could look into. Most of real estate tokenization that you'll hear about at this conference and other conferences typically pertain to commercial real estate, and in most cases they're doing fractionalization of that. So generally those would fall under the securities regulations. There's exemptions like Reg D, 506C, or Reg A+, and the lawyers on the panel can talk more about that as well. But we wanted to use the composability of the Ethereum blockchain to see if there was a way we could offer a product that would not be a security. Real estate as an investment asset class, people have been buying and selling those for years. It's very well established. And in the TradFi world, people also buy real estate using LLCs for liability protection. So using the existing formats that already work in the real estate space, at least for single-family rentals, we just wanted to explore how could we use Web3 technologies to make the sale and settlement process a lot faster. So in our case, the single-family rental asset is titled to a very specific single ownership Wyoming LLC. And the ownership of that LLC in the operating agreement, the legal agreement of that LLC, it refers to the Ethereum blockchain, specifically the wallet that has the token ID associated with the specific smart contract to essentially indicate to the LLC who its owner is. And so with that construct, when the NFT sells on an NFT marketplace, and we've now sold a couple of them on our native marketplace, which is hosted by Origin Story, and we recently sold one on OpenSea. So it's sellable on any NFT marketplace. So once you do that sale, it instantaneously settles, and the new wallet that the NFT goes to then becomes the owner of the LLC, and therefore the owner of the underlying property. And that allowed us to abstract out the traditional processes involved in the transfer and closing that takes, typically involves a lot of intermediaries and it takes weeks to do. And we were able to instantaneously get these assets to settle on the blockchain. We also worked very closely with securities lawyers to make sure that what we were creating would not somehow trip securities laws. Again, if it did, then you would not be able to sell it on OpenSea, because OpenSea would then be an unregistered broker-dealer in that case, right? So mainly, of course, everybody looks at Howie, and happy to talk about that in detail. But we looked at Gary Plastics, Williamson Tucker, a lot of other existing case law to essentially see that we didn't want to trip vertical commonality, horizontal commonality, certainly the expectation of profits from the efforts of others. We focused a lot on the efforts of others prong as well. And so we created a structure that's not only legally compliant, but also will intentionally fail the Howey test. So that's sort of how we did it. And then with Teller, the advantage was you don't actually need to do consumer lending for these, because these properties are going to be used for rental purposes. So you can do asset-based commercial lending. And they already had a product that was built for this specific use case, so it was an easy plugin for us to work with them on that.
Yep, I think it would be great if Ryan could, or Jonathan, if you want to add something quickly.
I got so many questions. Like me and your lawyers have got to talk, because I've got heartburn up here now. I don't know how you get around the Exchange Act by selling an NFT that has ownership in an LLC. I mean, that rings of security to me. But you've got highly paid lawyers, and believe it or not, guys, lawyers disagree all the fucking time. So, maybe I guess you can go back to the technology point, because that is what we're here for hopefully eventually getting everybody cheaper mortgage rates and doing some really dope things one day. But yeah, go back to that.
That's the dream, right? The mortgage rates today are controlled by where the Fed rate is. The dream is that it's truly a market rate. It's not purely set from the Fed rate. And I think with crypto, the magic is you can purchase an asset instantly. So as we have these legal structures come to life, we will have that Zillow-like experience where you're browsing and with one click, you can own this home. And while so many platforms have gone down the fractionalization side of real estate, which is exciting because anyone around the world can participate in real estate. But for many consumers, that touch or that connection is with purchasing a home outright. And that's where we at least felt, pairing up with Roofstock, that financing really started to kick in and tell a narrative of crypto is bigger than just speculation. Crypto is something that will contribute to the global financial economy. So from a technological standpoint, getting financing on property should be no different than getting financing on Bitcoin or on any CryptoPunk or in Bored Ape. And that's why rental property made so much sense to start with, because you're able to not go through the same consumer underwriting that you would have to if it was a consumer purchase of property. So with the properties listed on Roofstock, all of them being rental properties, it made it very transparent for us to work with different investors that Roofstock works with to purchase these properties outright for that investor and to help with the financing side. From the tech standpoint, the properties that were purchased in one transaction. So you can imagine going from a 30 to 60 day closing period to it's just a smart contract transaction. It's one function. It takes 30 seconds to write on chain, and you now own your home with financing.
you mind if I ask a question?
Yes,
I
please.
loved hearing about the mortgage rates because, not to be an idealist, we're here because of Satoshi and we're here because of Vitalik's belief that it's good to be able to own things yourself on chain, and then finding a way to kind of increase efficiencies in society. So what then becomes the solution to the idea that you guys have a great couple of companies here and you've got investors and you want to do quite well? How do we avoid the problem of when these inefficiencies are solved, that the value capture isn't centralized in the underlying corporate entity?
I got it. We're going to get deep here, folks. Sorry, hang on. So in theory, right, like let's say you want to go buy a house, single family home. We got your like rental history. We got all this kind of fun shit about you. We know, what kind of underwear you're wearing right now because it's on chain, right? Well, not yet. One day it will be, right, with the metaverse and all these other kind of fun things. So then it becomes a question of, okay, where are you buying your property? Oh, you're buying it in a nice neighborhood. Oh, you have a nice job. Oh, you're a pretty safe risk. Maybe we will create a stable asset that is backed by that commercial property like they do right now, and we just don't get any of the upside from it. So we're looking at like these weird worlds of possible universal basic income because we all trust each other to pay each other's fucking mortgage, or else we're all in a lot of trouble, right? And so instead of having the securities world buy and sell and swap our stuff, we can all say, hey, we're in part of this, giant, weird Satoshi-like world of we believe in each other and to pay each other's mortgages, and in that same sense, we are loaning against that property. So as long as you keep paying, we'll keep producing the yield.
I get that, but then the question becomes who's in charge of the very system that is capturing all those values.
That's up for the tech guys. That's not for me.
Well,
I'll tell you
yeah,
how to make it legal.
The question was for them, so I'd love to. You got it.
We start with
You can keep this in
Satoshi.
reserve.
I mean, Satoshi's concept is remove money from the state. So why can't we take that a step further and remove interest rates from the state? And you then get to a more laissez-faire economic status where interest rates are set by the risk-free market. If we're to look at DeFi today, Aave, Compound, over-collateralized lending protocols are the risk-free rate of DeFi. There's no doubt in my mind over the next decade we will start to see that in different asset classes, and I do hope that becomes real estate. Because if we can show that while the state, based on the current interest rate set by the Fed, it looks like this, but if potentially in the DeFi world we see it as lower, you now have a massive consumer base that will flock to DeFi purely because of the value proposition of the better rate that they get.
And, to add to that, right, I think that the two buyers who bought these properties levered through Teller, they came from Web 2. They didn't have a self-custody wallet until that point. I had to send them a YouTube video on how to create their own self-custody wallet and then make sure they kept their seed phrase safe before we did the transaction, right? And they simply went through the trouble of learning all that for the convenience of getting a loan in less than 30 minutes, right? When you look at TradFi, if you're a retail investor that's looking to buy individual properties, right? The Fannie Mae guidelines allow you to get up to 10 rental properties through the DULP underwriting process. When you get past 10, there's suddenly this huge chasm, right? Because the very large institutional investors who might want to buy hundreds of homes, they can go to Goldman, Citi, Barclays, and get a nice warehouse line, build it up, and then when it's 200 million, they can securitize it. But the small guy that wants to go from 11 to 50 is out of luck because you're looking at non-bank lending options. Typically, those types of private credit or hard money loans will not only have higher rates, so it's at least 200, 300 basis points more than what you might pay for a Fannie Mae loan. But on top of that, often they require personal guarantees and other kinds of cross-collateralization, right?
Terrible recourse, yeah.
Yeah, absolutely.
So
So
everything up on the line.
coming to DeFi, you get rid of all that because it's purely asset-based, and you don't have to go through that complex underwriting process. And there's no limitation of the number of properties you can buy using one process or the other. So we see that as the kind of key that's going to open up RWA and DeFi and Web3 going forward. Obviously, there are some impediments to that, wallet being one. So wallet as a service can change that in the future. How do you get enough USDC to put a down payment on a property? That's a little bit of a challenge today. But in the coming cycle, we see that there's a lot of companies building tooling and infrastructure to solve these types of issues. And that'll bring a lot more Web 2 people towards Web 3. That's our hope.
So, Sanjay, you talked about earlier how you structure your transactions abstracting title within an LLC. And I understand that there's some legal inefficiencies with that. Do you expect that to be the model that's prevalent moving forward, or do you expect, any sort of legal changes to help make it more efficient?
So just to clarify, the innovation we created was not putting the property in the LLC. People have been doing that for years, right? The only innovation we did was, and these LLCs, typically the form of ownership in the US can be certificated or uncertificated. Most ownership these days is uncertificated. And so all we did was we said that in order to prove the uncertificated ownership of this LLC, you just need to look into the Ethereum blockchain, right? So that was the only addition we did, was say, point the ownership of the LLC to be resolved by looking at the wallet on Ethereum to figure out who the owner is, right? So far, we're still staying within the existing construct of LLC-based property ownership, and simply saying that instead of that ownership just being signed in an operating agreement and stored uncertificated, now you can actually refer to the Ethereum blockchain for that. So that's all, from a legal innovation, just by adding that one element, we were able to unlock the ability to essentially sell and settle instantaneously on the blockchain. Of course, a lot of legal work was done on the securities analysis, real estate analysis, commercial law. I mean, we had at least half a dozen big and boutique law firms working on different things to make this happen. So certainly, 7-figure legal bills getting there, but the good news
So
is
does Ripple.
Yeah.
I mean, if you don't mind, I think we have a long way to go when it comes to the legal side of things. And I know that's cliche. I've been in this space since 2016. I was telling everybody, don't do ICOs. Imagine how popular that was. But I think in totality, right, and while I disagree that you guys were the first, I do think we have to be here together, right? Well, second maybe. Second, take second, yeah. I think if we can really, truly innovate and we can get at the local level, if there's somebody in here who is part of their local government and they want to bring a new world, right? Web3 is coming. You're not going to stop it. So what happens if we can start tokenizing actual physical real estate and then offering it to people, right? And these I'm from South Carolina. We got towns that are tiny. You don't even have a stoplight. You drive through and you miss it. If we can have the opportunity to tokenize some of that real estate and give people who don't have homes an actual piece of property, that type of revolution is unheard of. And I would really hate to see that go elsewhere, which I think is going to happen because our regulators right now don't know whether it's a commodity or security or this weird in between. And so this is just me begging and pleading for everyone who is in here, recognize that we're all in this together. And if we fix it, we don't get another great recession, which they're trying to do right now. All right? So let's just have that as the overarching thing. We are all in this together, regardless if they were second.
I do want to hear a little more from you, Jonathan. You do have pretty extensive legal experience, and I know you've helped people in this space before. What are some of the problems that people come to you with? In other words, what should people avoid to get in trouble in this space in terms of securities with real estate?
So real estate's really hard because it already is physical property, so you need some type of exemption. You need to either be a broker or agent or something to have some type of ability to sell on behalf of someone else. Now, if you're the first seller, if you are the person who owns bona fide interest, you do not have to worry about that. You're an exemption. Same as you would have an issuer exemption from a company standpoint. And so by utilizing those exemptions, I think that's where we start pushing the county records in some of our states to really start saying, hey, Wyoming, you're doing a great job, but what if we did this? We're doing something, I can't unfortunately mention it right now, but I hope in the near future you will hear about some really cool things out of South Carolina, but it's not the state of South Carolina doing it. And that's a combination of really smart people working together to make sure that this future is something that we all see coming and we see the problems with it. And so let's realize it. But the questions that we get are really ICO related. Hey, we're doing this kind of thing. We're going to make money and then we're going to give it to everybody. And you're going, wait a second, hold on, back up. Why? How are you going to do this? And there are some weird rules. Let's just say securities and intellectual property rights are very, very different. So if you can figure out how to tie those together, this is not legal advice, but that might be very beneficial. Look into that, hire a lawyer. Get a legal opinion, get it in writing for God's sake. Because we've had those problems where people have gotten Web3 advice from some Web2 lawyer or Web3 lawyer or Web2 lawyer who's got, way more experience in whatever they're doing in the Web2 world. But as soon as you hit Web3, boy, it's a different world. So you have to have somebody who knows what they're talking about, because I've read opinions. I just got a really, really well done opinion from a very, very expensive UK law firm. And I said, hey guys, this is a gaming token. You didn't touch on the gaming element of it. What is that like in gaming? And gaming's gambling, guys. So they weren't, thank you. We'll get back to you on that. That type of stuff. Like if you're not talking to a lawyer, if it's truly somebody who's in a Web 2 and you're trying to bring in the Web 3, that's fine. We need more Web 3 lawyers. I'm tired. I'm fat. I'm overweight. I need to go do more exercise, but you guys stress me out, so I have to keep working. But in all seriousness, it's a situation where if there is a question, have them call me and say, hey, is this legal? Because I can tell them, because then they'll be on the hook for it, right? But in seriousness, get legal advice. If you're in that space where you're like, hey, this is something new, this is something scary, please get legal advice. I can't say that enough.
So I'd like to add something to what you said, right? Commercial real estate has been sold as securities, exempt securities forever, before blockchain and all these technologies came about, right? Private placement Reg Ds, either as general partnerships or limited partnerships, that's been happening for a long, long time. So all we've done now is made the distribution a little bit easier, and the ownership, the provenance of who owns what can be easily tracked on the blockchain, right? So you can still use the existing frameworks of Reg D, Reg A+, and all that to issue tokenized securities, right? So the primary issuance, as John pointed out, you have issuer exemptions. If you're not taking a commission, you're not acting as a licensed broker, and through the issuer exemption, you are allowed to sell securities. The real challenge today is secondary liquidity, right? One of the biggest opportunities people talk about with blockchain is that you should be able to have really good secondary liquidity, which smart contracts and programmable money can easily accomplish from a technology perspective. But from a legal and regulatory standpoint, we're not there yet, because ATSs where these sales can happen have to be approved by the SEC and can only be run by FINRA-registered broker-dealers. And while there are a few ATSs that have gotten licenses to exchange digital assets, special purpose broker-dealers have not yet been approved to custody digital securities or to be able to transact in digital currency. So all of the BD ATSs that are in the space right now have to run through hoops to hire a transfer agent to actually keep track of ownership, perhaps have a custodian, and there's a complex process of how you would do secondary trading through these. You'd actually have to send fiat in first, and that fiat goes to some custodial bank, and then you're getting the trade done on the digital security, but it settles somewhere else at the transfer agent level in a different way. So those complexities have to go away before commercial real estate or any other real estate can be much more freely tradable in the secondary market. And I think that's going to require some regulatory changes and catching up, frankly, from SEC and FINRA, right? So we might be a few years away from all that happening. In the meantime, people are still doing primary issuances of CRE, commercial real estate, and you'll hear often about somebody tokenizing $1 billion of multifamily or office buildings and so on. And those primary issuances do need to keep happening, and perhaps in the next few years, we'll see secondary markets getting different and more secondary liquidity getting injected as well.
I can add, I think what's also interesting about secondary liquidity is recourse. We lightly touched on recourse. In the traditional world, for commercial real estate, I mean, that can take 6 to 12 months, 18 months. With crypto, if you are doing financing through the ideal scenario, a blockchain-like solution with smart contracts, recourse is instantaneous. The minute that the borrower defaults on the loan, that property can be recourse by the lender and sold off. So the foreclosure process, from a lender's point of view, goes from this painstaking and lengthy process to one transaction. And actually, that is the unique selling point for traditional lenders, as we've been speaking to them. They ask why blockchain. If they are a lender coming from Web 2, if they're a traditional bank, they already are processing high volumes. This is that wow factor. This is what gets them over the ledge is recourse.
Yeah, no, it's a great point. One thing I wanted to add to that is, in the traditional world, typically when you're trying to get a lien perfection on a real asset, you have to have a mortgage. That's how you get perfection on the lien. And once you have a mortgage, there's there are judicial states and non-judicial states. They have different foreclosure processes, but it can take 6 months, a year. And then once it's foreclosed and it becomes a bank-owned asset, some states have redemption periods. You have to wait, for that to go through before you can go and resell the asset, right? So the liquidation upon default is a somewhat, while it's a proven process, it's a time-consuming process. Our product that we're doing is a little bit different because really there's an LLC involved. The loan is not going directly to a property. It's going as a commercial loan to the LLC. The borrower is providing a pledge of equity in the LLC, and that's getting perfected on-chain using the NFT, right? So there's a slightly different mechanism to get to the assets of the LLC in our case, and that makes it a lot more flexible for, think of it as an analogy, it's like a springing mortgage where the mortgage has already been sprung, right? So that's sort of the framework we went for to make it simpler and more closer to being Web3 native.
Yeah, real quick. That's the problem with doing like personal stuff, right? Like personal real estate is really heavily regulated because you don't want to kick Nana out of her house because she lost her seed phrase, right? Let's stick with that theme. So yeah, we've got a lot of work to do, but that's why I'm saying like we have to start now. Like we really truly have to start now. We cannot wait for boomers and people who don't understand how Facebook works to like really try to put this together, like, or else we're all going to be screwed.
So I think we've got about 5 minutes left, so maybe we can just go down the line. And I'm curious, what do each of you think are steps that we can take, or the industry can take, or that need to happen to accelerate adoption of real estate tokenization and real-world assets in general?
Well, I'll start because I wanted to address your point as well. I'm not sure we should try to accelerate it, quite candidly. I don't have a business in it, but I think there's a lot of value in walking before we can run and being mindful of the core ideals that will be appealing to a sufficient majority of the population that they're even interested in this technology. Because otherwise, we're here in this room, we're here in this building talking about grand ideas and ways to connect and ways to localize finance. But if we're not showing how it can work for Ma and Pa America and in the developing world as well, then we're not going to have a coherent message. We're not going to have something that can really improve society. So if it's all about increasing efficiency on the blockchain and making sure that securitization happens efficiently and centralized entities continue to make a large profit as we are now, we haven't changed anything. So I think there's plenty of time to slow the discourse down and talk about how real estate as an NFT can actually work for the people and not just for the businesses that are providing the instrumentalities.
How did you go from quoting Satoshi Nakamoto and Vitalik to that? Like we got it like...
I'm a philosopher.
Fucking lawyers. I would like to throw the question back at you, sir. What is PwC seeing? Like what that you can tell us about would really make you guys interested in from an accounting perspective? Because I think that's where we still have to deal with you guys and all that fun stuff. The numbers. I'm a lawyer, I don't like numbers.
Yeah, I don't work directly with real estate tokenization, but I think much of this, just having these conversations, getting more clarity about what the regulation needs to be and making sure people understand that, because I think there's a lot of gray area right now that people don't know. And PwC is in a unique position to talk to clients. We have a reputable brand, people respect us, and so we are in the position to do that. And so I think the more and more clarity we get, the more we can invoke those conversations and hopefully improve this space quicker.
I think adding to that, there's like 3 prongs that I see from a DeFi specific perspective. And the conversation happening here is the really hard problem to solve, the legal, the regulatory problem, which is asset tokenization. That's part 1 of this ecosystem. Part 2 is liquidity to purchase the asset. So that's having buyers lined up who are exploring assets to purchase on chain, such as real estate. And then the third is lending liquidity. And those 2 parts, we can easily see how that comes to blockchain. You have OpenSea or Uniswap, depending on how the real estate is tokenized. And coming to fruition, you now have lending protocols like us that are supporting these assets. That's when this ecosystem becomes really fun because everyone can get involved. Unlike the traditional process of having to go see homes, dealing with the different lending, like traditional finance lenders that you work with today, the time span it takes, you can buy property instantly. And from our perspective, those 3 prongs are going to really pick up as the hard problem is solved, which is the title.
Yeah, I mean, I'd just like to add that I think from the buyer's perspective, especially Web2 native buyers, having wallet as a service and other types of abstraction really helps take away NFTs or blockchain, because people don't really want to hear about any of that. It's like I go to Starbucks with my iPhone and it has a wallet inside it and it has my credit card. I just need to point my phone at a device there and it pays for my coffee, right? I don't care how the technology works as long as it works. So it's the same for Web2 people. They don't need to understand blockchain or NFTs or any of that. They have a wallet, and that wallet has USDC. They should be able to transact and buy assets with it, not just real estate, but other real world.
I would love them to understand enough to figure out why we're all here. I think it's a little bit different. So to the extent we can educate the folks on why we believe that this stuff is uniquely applicable to the business we're building out, I think that's always going to be a positive.
Sure, that certainly helps. Education is really important. We have to continue doing that. But to get to the 100 million to a billion users, you're going to have to abstract a lot of this away as well, right? From the DeFi perspective, I think it's really interesting. In the next cycle, I expect a lot more Web3 native money to come into RWA assets, because they've all done the under-collateralized or over-collateralized crypto lending, and that's all led to various issues that now we're recovering from. And I think the industry recognizes that RWA is an important part of the future, right? In addition to that, you guys might have seen that the US Department of Treasury put out a statement saying that DeFi protocols are financial institutions, probably should be covered by BSA. So we're going to see a lot more regulation around that, because the US government certainly does not want terrorism and money laundering to be funded through DeFi. We're going to see more permissioned architectures on permissionless blockchains. So you can still use Ethereum for composability and then have a KYC layer on top of that that gives you the permissioning needed to do this, right? So I think that's the direction in which we're going. And if we do all of those things properly in the next year or two, we should see a lot more adoption.
Awesome. Well, I think we are at time, but thank you to our panelists for that insightful information. Hopefully everyone learned something, and thank you for coming.